Good evening and welcome back to the latest edition of the InvestTalk market analysis for the week ending May 3rd, 2024. And this week I'm going to title the video, Is Fed Policy Pushing Us into Stagflation? And we had a lot of economic news Wednesday through Friday of this week. We had the Fed meeting on Wednesday. The Fed didn't do anything as expected when it came to the changing of rates, but they did lower QT from 60 billion per month to 25 billion starting on June 1st, and that was a bit better than expected. Everyone was expecting to go down to 30 billion, and it came in at 25 billion. Okay, so that was a bit dovish. We got the Treasury refunding announcement as well. That was a bit hawkish because there was more debt that was is expected to be borrowed here over the next 6 months or so, and uh, that means more liquidity could come out of the market. Now, when it comes to what type of issuance they're going to have, it's going to be more on the short end versus the long end, and so that was a bit dovish. So kind of a mixed bag here, but overall positive for liquidity, I would say, going forward. So that was that was that part. But the economic news, let's dig into that because we talked about stagflation here, and we'll start off with construction spending that dipped into negative territory. So you have two of the last 3 months negative month over month construction spending. You also had continuous claims for unemployment. That was positive, kind of dipping to actually flat week over week. So, but not breaking out here, right? So this is, we talk about this all the time. It's not about how many people are filing for unemployment, but it's how many people are staying on the unemployment rolls, and that's been fairly steady since October. Productivity. This is the part where you say, okay, stagflation. When you have look at productivity down to 0.3%, that's not good. You had 3 quarters in a row, excuse me, a very solid productivity growth, but that did give a step back here. And productivity growth is what allows the economy to grow without excessive inflation. When you get more out of each worker, it means that you can keep prices down and you can still grow. Okay, so productivity is very important long term to see this at least in the 3% range plus per quarter. And it's only one quarter at 0.3%, but still not a good sign. That was for the first quarter. U.S. capital goods new orders, that did tick up, so that was a positive, but you can see down from the highs of 2023. And then we had the jobs number on Friday. The average hourly earnings did tick down again below 4%. So that was positive for the inflation front and what the Fed is looking at. So that was good. But you also had the ISM services PMI, and that dipped into negative territory down to 49.4. So shrinkage in the services side of the economy, which is known as the vast majority of the economy. Employment index, that dipped lower to 45.9. And then on let's go here real quick, the prices paid, that did tick up though to 59.2. So in contrast to the average hourly earnings, the services prices paid index did tick up 59.2. So that would be inflationary, but most of the other data points on the ISM figure was deflationary, or stagflationary, shall we say. And then you had the non-farm payrolls that ticked down to 175,000. So not a wonderful jobs report, but an okay one. Certainly didn't it did disappoint compared to expectations, and that's the kind of the broader picture that you're seeing, and you're seeing things. And I'll pivot over here to the charts real quick. And you saw Starbucks come out with earnings. Those was down, and that just showed a lot of their weakness was in China, but some of it was here domestically as well. And it shows you that the problems that the Dollar Trees of the world, here's Dollar Tree, and you can see that's been a downtrend. And that's because the lower end of the income spectrum has been affected by interest rates a lot more than the higher end, who have a lot of savings, are able to earn interest on their cash, etc., and keep their spending going. What you're seeing with the Starbucks earnings is that that's creeping up the income uh, spectrum. and saying, okay, it's not just the poor people that are not spending at dollar stores. It's the middle income consumer that is maybe feeling the pinch and spending a bit less. Okay, so I wanted to highlight that, and that's why I say it's kind of stagflationary. There is some progress on inflation, but it is kind of mixed and relatively sticky. Okay, and then when it comes to what all this means for policy is that ultimately the Fed is unlikely to cut in June and is starting to coalesce around September as that first cut. Here is only a 32% chance there'll be no cuts by September. And then December, after the jobs report on Friday, you did see the odds of 2 rate cuts by year end increase as well. And so that's kind of what you're likely to see is 1 to 2 rate cuts this year. Obviously, what happens with these recent data points are I don't want to say one-offs, but you're getting enough to say, okay, now the economy is starting to cool a bit in a more reasonable way, and so it could give the Fed more leeway to cut sometime, maybe this summer, maybe early fall. So that was the economic news Fed week. But let's dig into the charts, and we'll start off with the S&P. We looked at those few individual companies, but the S&P did have a nice up week. We bounced off that uh, there were two support levels or two data points that created support. One is this 100-day moving average, the green line, and then this other green line is that Fib retrace, the 0.25 retrace. So that produced that bounce here. Now, we're going to need to get traction. We have quarterly OPEX, not this month, but next month. And that roll off, there's a lot of notional value there. And what that basically means is that there's a lot of gamma hedging, and a lot of dealers are own the underlying. And as you get closer and closer to that, expiration, there could be some unwind of their hedges, meaning they would go sell the underlying stocks that they have sold options against. And so if we don't get any real good strength over the next, I'd say, week to 2 weeks, then you're probably going to see another stair step lower later in the month and into the month of June. And so that's what I'll be watching for. A nice rebound on Friday on the back of that Apple news, big buyback, and not great business, but better than expected, especially in China, is better than expected. And so things are fine on the Apple front, and that gave a nice bounce to markets as a whole. Now, let's take a look at the credit markets. This is another reason why, I don't think whether we get that next stair step lower or not, this is not a seasonal weakness in markets is not something that you should be really worked up about. And you should be looking to add to positions most likely on this pullback as opposed to trim on major rallies, right? So that's kind of what we're seeing, and the credit market's really holding in there. Energy, that was the weaker part of the market after a big run in March. This month, the month of April, excuse me, has been a nice pullback into the month of May, and really that's on the back of oil prices coming down. Here's BNO. This is Brent crude. So you see that pullback. USO, this is the WTI. So both of those are pulling back on maybe the indication that there will be weaker growth going forwards. You did have a bigger build than expected in gasoline and oil earlier this week, and so that brought prices back down. Now, one thing I'll be watching continually is the yen. We saw the yen or the Bank of Japan come in and support the yen. They do have a lot of foreign assets to go in there and support the yen, so they're okay with the yen devaluing, but they want to do it in an orderly way. And so far, I think it got a bit disorderly last week, and they wanted to quell that. And so, the fact that the Fed was a bit more dovish, and the Treasury was a bit more dovish on their plans as well. And so, that brought a bit of weakness to the dollar. You can see that here, and strength in the yen. So, any issues that are happening over there in Japan, I think are settled, at least in the near term. Now the MOVE index. So talking about Bank of Japan, what about our treasury market? The MOVE index is something I talk about all the time. If this gets some traction on the upside, that means maybe the Fed is being too hawkish, and the ability to fund the deficit is starting to become in question. And the fact that this is now in a downtrend, has been a downtrend really since the uh, banking crisis last spring, it tells you they're managing this well. Although long term, we know this debt level is relatively untenable. They're going to do their best to paper over this and kick the can down the road, and they can do that via the Fed and Treasury actions. So right now, no issues on that front. The VIX, that pulled back as well, and so you're back down to 13. We know lower volatility index, higher equity prices, higher asset prices. So everything's fine kind of on that front. You also saw on the jobs report on Friday, it was uh, the treasury yields did come back in, and so let's see if this, am I getting an update yet? I'm still not getting updates on my treasury chart, but what you can see here is the IEF. So 10-year treasury, this rallied, so yields dropped. So you might have seen a peak in yields, especially if you do get continued weakness in some economic data, and we'll see what that looks like next week. But I do think there's a decent chance that yields have peaked in the short term. Gold, look at this. This is just a bullish pullback. Nothing wrong here. The lower end of this Bollinger Band, uh, everything looks fine. Look at GDX. That's just in a consolidation period as well. Let's go look at silver. Silver had a bit more of a pullback, but still, this is just retesting this breakout area. No problems on that front. Let's go with the silver junior miners. Yep, that's consolidating as well. So the precious metal market remains in a nice uptrend, and this is just consolidating that breakout. Basic materials, that did pull back. This is nice support here. So if you're looking to add to the material space, this looks like a pretty good time to do that uh, based on the chart of just the materials ETF. What else do I want to get to? Growth to value. I love that growth to value, and just to see kind of, what's outperforming what. Let me get this typed in here correctly. They're always finicky with that. There we go. And you saw growth break out, that Apple earnings, but still kind of in this choppy period, trying to really indecisive. Now, if the dollar gets weaker and interest rates don't pull back very much, I think values is certainly going to head higher. Financials, this looks okay, decent pullback, but kind of similar to the broader S&P. The banking index, though, that looks relatively strong after underperforming the broader financials. This is starting to outperform, so that's something definitely of note. What else do I want to get to? Industrials have pulled back, but not that much, right? We talked about how just the strong relative strength of the industrial side of the economy is compared to many other sectors. I look at places like healthcare continues to be relatively weak. Look at that pullback. Biotechs also fairly weak, although it did get a bounce. But we know in a time when cost of capital is higher, biotechs, Ponzi stocks, right? ARK ETF, for example, those just are not doing very well. So, yeah, near term, I think probably continuation of that bounce in the S&P sometime, for the next week or two into this week's OPEX, and then what kind of reaction I think do you get around this month's OPEX as well as post OPEX? Do you get some, does it steady around that time, or do you start to see some relative weakness, and that could portend to that next level of support, which I've said is right here around 4,800. It would not shock me at all to get down there, but it would not be something to really worry about. But that about does it. I appreciate you all tuning in. I hope you have a wonderful weekend. A reminder, the contents of this video are for educational purposes only and should not be construed as a recommendation to buy or sell security or to participate in investment strategy. The views are my own, do not represent those of KP Financial or those associated. Have a wonderful weekend.